Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Phil wants to know, I guess the question's for me, if I think in-the-money options are easier to manage. Yes and no. I like to say that it's really up to the investor because, when you think about the in-the-money options, I'll go back to that. Now I scribbled all over this, but in-the-money options, are they easy to manage? I don't really think that any of them are that difficult to manage. What you're thinking about is how much did you pay versus, what are your goals and what are your risk tolerances. So in nominal dollars, you have the most risk buying that in-the-money option. So I like to think that the in-the-money option is a little bit more difficult to manage because you have more dollars at risk. Does it make it a poor choice? No. It's going to act more like the spot. So if you want something that's going to have what I call a high delta, which means how the option moves relative to the spot, well, there you go. You could look at that in-the-money option. Most options, because people like a bit of leverage, not what I like to say is over-leverage, most options are traded near the money. So what's a near the money or an at the money? That's going to be a 96 call. So when I'm teaching options, what I like to remind investors is start shopping at the money, the 96. Then move, if you want a little less leverage, to the next, maybe the 94. Or if you want a little more leverage, the 98 or even the 100. Of course, you can go to the 102 or the 104. That's just adding more and more leverage. You need to recognize you need a bigger move there. So I hope that helps, Phil. Let's see if we can get some other questions here. Just Paul missed a lot of it, Jack. I know he can come back for the archive. Remember, you can listen to Jack's presentation and all of Jack's presentations at www.ise.com/archives. Jack, what's the term carry trade and why is it done? If you can, I know we just gave an hour presentation on that, but Paul said he missed the whole presentation. Can you give him a 2 or 3 sentence synopsis on that?
Sure. The carry trade just means using a low-yielding currency, borrowing a low-yielding currency, and reinvesting the proceeds in either a higher-yielding currency to make the spread or reinvesting in an asset class you think is going to appreciate faster or at a higher return on investment than your borrowing cost. That's all that is. And generally it's done with the major currencies in the world. They are the carry trade currencies because the liquidity is there, the ability to borrow them is there, so that it also has to play that function. It has to be relatively low yield, and it has to be a decent amount of liquidity so you can borrow it. And there's other things in place, but in general, that's it. You're just borrowing and trying to get the spread on a higher yielding investment in the future.
Wow, Jack. So if the U.S. dollar does meet your criteria, right? It's low interest rate, and it's obviously very liquid. So I guess it is definitely a candidate for a carry trade, correct? Now, from the funding standpoint.
It is very much, and it is very much, we think, too, from a policy standpoint in here. As you notice that the U.S. government's doing everything they can to be the stimulators of the globe. When we had that bear market in the U.S. dollar from 2002 down to 2008, we had an implicit weak dollar policy because the dollar was used to fund all those asset classes out there, and it was great for the U.S. consumer, great for boosting up our asset markets. Now, the U.S. Fed and Treasury wouldn't mind that happening again. So it can be part and parcel to the policy. And one of the reasons we think it is happening here, at least has over the intermediate term, we talked about the yen, and one of the questions was from William, would you use the yen or the U.S. dollar as the funding currency? At the moment, because of the price action in the yen, we would suggest the dollar is the one being used now. And we say that because, in general, the yen is what's called a risk aversion currency, it tends to move up on risk aversion, meaning when people get scared, they bring money back into the yen, does okay. But in risk appetite, the yen usually does pretty badly because it has been the funding currency. But if you look at the price action in the yen relative to the dollar in this risk appetite environment, people getting back in the risky asset, the yen has appreciated or at least held up very, very well against the U.S. dollar. That's why we think the dollar is playing that role now to a degree. We think that game will change, again, in a very, very big way, and that liquidity will come rushing back into the U.S. currency, not again to get back into the currency, but to get back into the U.S. bonds. If you notice, the bonds have bounced pretty well off of that longer-term trend support, bounced higher bond prices. But if that money comes back in, meaning if they're disappointed that that these BIC or BRIC countries, as Andrew rightly points out, can't carry the weight, then that carry of the U.S. dollar will come rushing back just as it did and power the yen higher. So in this case, we would think the yen would depreciate in here because we think the correlation of the yen has changed because we don't think it's being used for that trade.
That's interesting.
I hope some of that made sense.
No, that's very, very interesting. So you see a shift in the correlations or, the historic correlations. I just want to go through a couple of the volatilities. I think it's helpful to understand for all of us option traders to see where these pairs have been over the last year. As Jack was talking about volatility, well, the market prices it every day. And I think all of you, well, let me just take a poll. Which of the 6 ISE currency pairs, which one do you think had the highest volatility in the last 52 weeks? Let's see if we can get this right here. Let's see. I'm going to scroll down and see. Which is it going to be? The yen, which is the yuck, Swiss franc? Is it going to be the Australian dollar, British pound, euro, Canadian dollar? So far, Andrew Finn says the British pound. Oh, not Jack Crooks, but Jack Crump actually got it. Second guess. The Australian dollar, and I think Jack Crooks referred to this in his presentation, that when you're looking at more and more risk, and we see what's going on with China, that the markets sort of see that and they play it out in the Australian dollar. Didn't you refer to that, Jack?
Yes, absolutely. We refer to it as the key major risk currency of the majors because of China.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.